In the summer of 1974, a small delegation of American officials flew quietly to Saudi Arabia for a series of meetings that officially barely happened. No treaty was signed in public, no press conference announced it, no congressional vote ratified it in the way major international agreements typically require. For decades afterward, the United States government kept key details of what was agreed classified. And even now, historians still debate exactly what was promised in that room, piecing the story together from fragments of declassified cables and the recollections of officials long since retired. And yet the outcome of those quiet meetings still shapes how you buy gasoline, how your government borrows money, and how nearly every major currency crisis of the last 50 years has played out. This is the story of the Petrodollar deal, an arrangement so consequential that it helped cement the U.S. dollar as the currency of the entire global economy, and so quietly negotiated that most people who fill up their gas tank every week have never heard of it. To understand why this deal even needed to happen, you have to go back 3 years earlier, to August 1971. President Richard Nixon, facing a currency crisis of his own making, announced that the United States would no longer convert dollars into gold on demand, an event that came to be known as the Nixon Shock. For nearly 3 decades under the Bretton Woods system, the dollar had been pegged to gold, and every other major currency had been pegged to the dollar. Nixon's decision effectively ended that system overnight. The dollar became what economists call a fiat currency, backed by nothing but the promise and credibility of the United States government. This should have been a moment of real danger for the dollar's global standing. A currency backed by gold has a built-in kind of trust. A currency backed by nothing has to earn that trust some other way. Foreign governments that had spent decades accumulating dollar reserves suddenly held an asset with no fixed, guaranteed value. Confidence in the dollar wavered through the early 1970s, and inflation in the United States was climbing. Something needed to anchor the dollar's credibility again, and it needed to happen fast. At almost exactly the same moment, a separate crisis was unfolding that would end up providing that anchor, though almost nobody could have predicted the connection at the time. In October 1973, following the Yom Kippur War between Israel and a coalition of Arab states, the Organization of Arab Petroleum Exporting Countries imposed an oil embargo against the United States and other nations that had supported Israel. Oil prices, which had been relatively stable for years, roughly quadrupled within months. Gas lines stretched for blocks across American cities. The embargo demonstrated something the United States government found deeply alarming, that a small group of oil-producing nations acting together could bring the world's largest economy to something close to a standstill. 2 crises, a dollar losing its anchor, and an oil market that had just proven its ability to hold the world economy hostage, created the conditions for an extraordinary trade. If the United States could not offer gold to back the dollar anymore, perhaps it could offer something almost as valuable: military protection and political alignment, in exchange for Saudi Arabia's cooperation in keeping oil priced in dollars and recycling its enormous new oil wealth back into the American financial system. The man most closely associated with negotiating this arrangement was Secretary of State Henry Kissinger, along with Treasury officials, including William Simon, who traveled to Saudi Arabia multiple times through 1974 and 1975. Simon, who served as Treasury Secretary during this period, had previously worked on Wall Street as a bond trader, giving him an unusually practical understanding of exactly how a foreign government might be persuaded to become a reliable, ongoing purchaser of American debt at a moment when confidence in that debt was shaky. On the Saudi side, the key figure was King Faisal, who had personally authorized the 1973 oil embargo and now held enormous leverage as the world's largest oil exporter. Faisal was reportedly motivated not purely by financial calculation, but by genuine anxiety about regional security, having watched neighboring monarchies fall to coups and revolutions throughout the preceding 2 decades, making an explicit American security relationship deeply appealing regardless of the specific financial terms attached to it. The negotiations were conducted with extraordinary discretion. Some historians argue this was because both governments understood how politically explosive the arrangement would look if fully public, tying American military commitments directly to a foreign government's cooperation on currency policy, at a moment when American trust in government institutions was already badly shaken by Watergate. Why did other oil-producing nations follow Saudi Arabia's lead in pricing oil in dollars, given that no formal agreement bound them to do so? The answer lies in Saudi Arabia's outsized role within the Organization of Petroleum Exporting Countries. As OPEC's largest producer and de facto leader, Saudi Arabia's pricing decisions effectively set the benchmark for the entire cartel. Once the world's largest oil exporter committed to dollar pricing, the practical and logistical costs of any other member pricing its oil differently, dealing with currency conversion complications, exchange rate risk, and reduced compatibility with existing global banking infrastructure, made dollar pricing the path of least resistance for essentially everyone else in the market. Kuwait, the United Arab Emirates, and other Gulf producers fell into line within a matter of a few years. Not because Washington negotiated separate deals with each of them, but simply because operating outside the dollar-denominated system that Saudi Arabia had established would have meant real, measurable friction costs for comparatively little benefit. This is where the deeper mechanics of the arrangement become genuinely fascinating. Economists later coined the term petrodollar recycling to describe what happened next. Oil-exporting nations, flush with dollars from oil sales far exceeding what they could immediately spend domestically, needed somewhere to park that wealth. Much of it flowed into U.S. Treasury securities and Western financial institutions, effectively recycling the money back into the American and broader Western financial system. This created a peculiar self-reinforcing loop. The world needed dollars to buy oil. Oil-producing nations accumulated enormous dollar surpluses, and those surpluses flowed back into dollar-denominated assets, reinforcing the dollar's centrality at every stage of the cycle. The scale of this recycling was enormous even in the earliest years. By the late 1970s, OPEC nations collectively held tens of billions of dollars in surplus oil revenue, an almost incomprehensible sum for the era, much of it channeled through major Western banks that then lent this money onward to developing countries eager to finance industrialization, sometimes with consequences that would contribute to the developing world debt crises of the 1980s, a story explored elsewhere on this channel. The petrodollar arrangement did not just stabilize the dollar, it fundamentally reshaped how capital flowed around the entire global financial system for decades afterward. Did Saudi Arabia ever seriously consider abandoning the arrangement? The historical record suggests the relationship, while remarkably durable, was never entirely without friction. Reports have periodically surfaced over the decades of Saudi officials privately discussing diversifying away from dollar-denominated oil pricing, particularly during periods of tension with Washington over issues ranging from the Iraq War to human rights concerns to, more recently, American energy independence, reducing the strategic importance of Saudi oil to the United States specifically. Yet formal public abandonment of dollar pricing never occurred, in part because the infrastructure built around dollar-denominated oil trading over 5 decades, from pricing benchmarks to settlement systems to the sheer scale of dollar reserves already accumulated, made unwinding the system extraordinarily costly for Saudi Arabia itself, not just for the United States. More recently, the strategic calculus has shifted in ways that make the original 1970s bargain look increasingly fragile. The United States, once critically dependent on Middle Eastern oil, became a net energy exporter in the late 2010 thanks to the shale revolution, reducing its own need for stable relations with Gulf oil producers. Simultaneously, China has emerged as Saudi Arabia's largest oil customer, and in 2022, Saudi officials publicly acknowledged for the first time that they were open to conducting some oil trade with China in yuan rather than exclusively in dollars, a development that would have been unthinkable to discuss openly just a decade earlier. Nothing resembling a full abandonment of dollar pricing has occurred as of this recording, but the willingness to even discuss alternatives publicly signals a meaningfully different dynamic than existed for most of the deal's history. This shift has coincided with a broader push among a loose coalition of nations, including Brazil, Russia, India, China, and South Africa, collectively known as BRICS, to explore trade settlement mechanisms that bypass the dollar entirely. Saudi Arabia's own relationship with this bloc has grown closer in recent years, including discussions around expanded membership and participation in BRICS-linked financial institutions. None of this has yet produced anything resembling a genuine alternative to the dollar's role in oil markets. Trading relationships built over 50 years involving trillions of dollars in accumulated infrastructure, pricing benchmarks, and financial instruments do not unwind through a handful of headlines and diplomatic statements. But the direction of travel, however slow, represents the first sustained erosion pressure the petrodollar arrangement has faced since its inception. And it is happening at precisely the moment the original strategic logic binding Washington and Riyadh together has weakened the most. So who benefited from this arrangement across 5 decades, and who bore the costs? The United States gained an extraordinarily durable source of dollar demand precisely when it needed one most, along with decades of relatively cheap borrowing as foreign governments, led by Saudi Arabia, continuously purchased American debt, helping keep U.S. interest rates lower than they otherwise would have been across multiple decades of expanding federal deficits. Saudi Arabia gained an implicit security guarantee from the world's most powerful military, protection that arguably preserved the current ruling family's hold on power through multiple regional conflicts, the Iran-Iraq War, the Gulf War, and internal challenges over the following decades. Global oil markets gained a stable, predictable pricing mechanism that, whatever its flaws, avoided the chaos of dozens of currencies competing to price the world's most strategically important commodity. But the arrangement also concentrated enormous financial power in a relationship between two governments, one a hereditary monarchy conducted for decades with minimal public transparency or democratic oversight in either country. Developing nations that borrowed heavily during the petrodollar recycling boom often found themselves trapped in unsustainable debt when interest rates rose sharply in the early 1980s, a crisis whose roots trace directly back to the flood of recycled petrodollar capital searching for returns in the preceding decade. And the deal's very existence illustrates something uncomfortable about how global financial architecture actually gets built. Not through careful multilateral design with broad input, but sometimes through quiet bilateral bargains between two governments, each pursuing narrow self-interest that end up shaping how the entire world conducts trade for 2 generations afterward. The institutional legacy of those 1974 meetings extends well beyond currency markets. The U.S.-Saudi Joint Economic Commission, established the same year as part of the broader package of agreements, formalized decades of technical cooperation, infrastructure investment, and defense industry ties that persist to this day, largely outside public attention because none of it carries the dramatic framing of a formal treaty requiring Senate ratification. This is, in many ways, the quiet signature of how the petrodollar system was built from the beginning, not through grand visible declarations, but through durable institutional plumbing constructed specifically to avoid the scrutiny that a more formal arrangement would have invited. Which brings the story back to that quiet delegation flying to Riyadh in the summer of 1974, and the decades of consequences that followed from meetings so discreet that their exact terms remain partially obscured even today. The dollar's continued dominance after 1971 was never simply a story about American economic strength speaking for itself. It was, in significant part, the product of a specific, deliberately quiet bargain between two governments, one desperate to anchor a currency that had just lost its gold backing, the other newly flush with oil wealth and eager for protection. 50 years later, as energy independence and shifting geopolitical alliances slowly erode the original logic that made the deal necessary, the world may finally be approaching the moment when the quiet handshake of 1974 starts to genuinely, meaningfully unwind.